Welcome to The Explainer. I am so thrilled to have you here today. You know, if you've ever turned on a financial news channel, opened a newspaper, or even just glanced at the trending business topics on your phone, you've definitely seen them, the exact same recurring characters, the Sensex and the Nifty. Today, we're going to demystify these stock market indexes, cut through all the jargon, and figure out exactly what these numbers measure and how the whole thing actually works.
You hear it literally 100 times a week, right? Sensex up 300 points or Nifty nears 24,200. But let me ask you a really basic question. 300 points of what exactly? You can't just go to your broker and buy one share of the Sensex. So what is that number flashing in green or red on your screen actually telling you? Well, let's dive in and decode the mystery.
Here's our roadmap for today. First, making sense of the market noise. Second, Sensex and Nifty explained. Third, how the number is built. Fourth, the big sector movers. And finally, why all this actually matters to your wallet.
So let's jump right into part one, making sense of the noise. Why do we even need these indices to begin with?
Here is the fundamental problem. There are thousands of companies listed on India's stock exchanges. If you tried to watch all of them at once, your eyes would just glaze over before you even finish the A's. It's literally impossible. So somebody incredibly clever built a shortcut. An index is basically just a scoreboard for a specific slice of the market. Instead of following dozens or hundreds of share prices separately, you just pick a basket of important companies, roll their prices into one single figure, and track that number over time. It essentially acts as a single heartbeat for a whole crowd of companies. If that number goes up, the companies in the basket are worth more on average than yesterday. If it falls, they're worth less.
I love this analogy because it hits the nail on the head. Picture a cricket match. You don't need to recite all 11 batsmen's individual scores to know how the innings is going, right? You just glance at the team's overall run rate and you instantly get the vibe. Well, the index is exactly that. It's the run rate for the entire stock market.
Which brings us right to our next section, Sensex and Nifty explained.
These are the two most famous scoreboards in India. First up, the Sensex. It's run by the Bombay Stock Exchange, or BSE, and it tracks 30 large, well-established companies. It's actually the older of the two. It started with a base year of 1978 to 79, set at a starting value of just 100. So when you see a Sensex of around 80,000 today, it roughly means those 30 companies, as a group, are worth about 800 times what they were back then. Pretty wild, right? Then we have the Nifty 50. This one is run by a subsidiary of the National Stock Exchange, or NSE. And as the name gives away, it tracks 50 companies. Its base date was set in November 1995, starting at an initial value of 1,000.
Now, there is a massive number we need to talk about, 0.99. You might think that because these two indices are run by rival exchanges and track different amounts of stocks, you kind of have to pick a side. But you really don't. The correlation between their daily moves sits at a staggering 0.99. They overlap heavily and move almost perfectly in lockstep. When one is up for the day, the other almost always is too. They're essentially telling you the exact same story, just with two slightly different accents.
Okay, we know what they represent, but how do they actually come up with the exact points? Let's move to part 3, how the numbers actually built.
Both of these indices use a method called being free float market capitalization weighted. Now, I know that sounds terrifying, but let's just unpack it. Market cap is simply a company's total size in the market's eyes, right? It's share price multiplied by its number of shares. But the absolutely crucial part here is free float. This means you only count the shares that are actually available to trade in the open market. You completely ignore the massive blocks of shares that are locked away with promoters, founding families, or the government. Because think about it, if those shares aren't going anywhere, they really shouldn't be swaying a number that's meant to track live active trading.
So how does this turn into the final index number you see on the news? It's a surprisingly straightforward three-step logical process. Step 1, you add up the free float market value of every single company in the basket. Step 2, you compare that massive total to what that exact same basket was worth on the base date. And step 3, you scale that ratio against the base value. That dialed up or dialed down ratio, that is your live index level.
And because of all that math, we arrive at a really critical realization. The index is a weighted average, it's not a head count. That means size absolutely matters here. A giant, heavyweight company with lots of freely traded shares is going to move the index way more than a small one. A 2% jump in a heavyweight can literally drag the entire Nifty upward, while a 2% jump in the absolute smallest member of the basket, well, that might barely even register on the scoreboard.
And because it's a weighted average, the market isn't exactly a level playing field, which brings us to part 4, the big sector movers.
The Nifty 50 basket is definitely not evenly spread. As of early 2026, it leans heavily on a few giant shoulders. Financial services, so your banks, NBFCs, and insurers, made up roughly 37% of the Nifty 50 all by itself. Oil and gas and IT were the next biggest slices. So the real takeaway here is this. When a news anchor tells you the market rallied today, a lot of the time you're really just hearing the big banks had a really great day. The index has a very distinct tilt. It is absolutely not a perfectly balanced cross-section of the entire economy.
And there's one more vital thing to remember about this basket. It isn't frozen in time. The Nifty 50 is actually reviewed twice a year, in March and September. During these reviews, companies that have kind of faded out and lost their massive market caps get swapped out for new ones that have grown into the big leagues. The index quietly renews itself. It ensures it always reflects the current heavyweights of the economy, not just the champions from a decade ago.
All right, we've covered the math and the mechanics, but why should you actually care? Let's get into our final section, why this actually matters.
Let's put some real-world perspective on this whole thing. Say the Nifty 50 was hovering around 24,200 in mid-July 2026. On its own, that number is basically meaningless. Nobody goes out and buys one Nifty, and it's not actual rupees in your pocket. Its power is entirely in comparison. Was it near 22,000 a year earlier? If so, India's large companies grew in value. In fact, as of March 2026, the Nifty 50 captured an incredible 54% of the free float market value of all NSE-listed shares. So when you watch that single number, you are literally watching more than half the traded market breathe in and out. That's exactly why a fund manager can just glance at the Nifty instead of reading a spreadsheet of 50 individual stock prices. But hey, it touches your money too, probably in way more ways than you even realize. If you have a systematic investment plan, an SIP, and an index fund or a Nifty 50 ETF, you are literally buying this exact basket in miniature. Your returns rise and fall directly with the index. Plus, a slice of your employee provident fund, your EPF, is actually invested in index-based ETFs. So your retirement corpus is quietly riding on this exact scoreboard, even if you never place a single trade yourself. And look, even if you don't own index funds, the index is the yardstick everything else is measured against. If you pay an active fund manager a fee, and they return 10% in a year where the Nifty did 14%, well, you just paid someone a premium fee to do worse than the plain automatic basket. You'd literally never spot that underperformance without knowing the benchmark.
Knowing what the index measures turns a random background number on a TV screen into a seriously powerful tool, one you can use to evaluate your own financial future. The next time a headline shouts, "Nifty up 250 points," don't just react to the drama. Ask yourself, up from what and by what percentage? Because a 250-point move at 24,000 is barely 1%. It's often just noise. So I want to leave you with a tiny challenge for today. Pull up any mutual fund or ETF you currently own. Which index does it track? And more importantly, did it actually beat that benchmark this year? Go check your portfolio and let that question sink in. Thank you so much for joining me for this explainer. Keep asking questions, and we'll see you next time.